If, like me, you own a global ETF and you've added a Nasdaq ETF on top, there's a good chance you're not actually as optimized as you'd hoped. You might be doubling down on the same companies. That's exactly what I realized about my own portfolio. Up until March, my growth pie looked like this: 70% VWRL and 30% EQQQ. On paper, it seems okay. In reality, it's heavily tilted towards US megacap tech. And as of March 2nd, 2026, I've changed it. Not because tech is bad, not because I'm predicting a crash, but because I realized something important. Over a 20-year investing horizon, structure matters more than hype. Today, I'm going to show you why I'm replacing the Nasdaq 100 ETF and what I'm replacing it with, what I've actually built with the new allocation, how much of the new asset is optimal, what this likely means for returns, and why this is a smarter long-term design. This isn't a reaction, it's a calculated upgrade, at least in my opinion. Let's start though with a look at the old growth pie structure. I had a 70-30 split with 70% to VWRL and 30% allocated to EQQQ. On the surface, there isn't anything inherently wrong with that structure. If that's a structure you hold and you're happy with it, that's awesome. But here is the issue for me. VWRL already holds Apple, Microsoft, Nvidia, Amazon, Meta. It's market cap weighted, which means US megacaps already dominate it, particularly the tech-heavy stocks as they currently dominate the market. By adding a 30% allocation to a Nasdaq ETF on top, I didn't diversify. I concentrated or duplicated in many respects. I increased exposure to US growth, tech, megacaps, one specific region, sector, and size. Now, those Nasdaq-listed companies have performed magnificently over the last decade. And I'm not saying they won't continue to perform well the next 10 years, but the last decade isn't the next 20 years. And that's the time frame that matters for me. So as of now, March the 2nd at the time of recording this, my EI growth pie will look like this. 80% allocated to my flag bearer, VWRL, which is the Vanguard FTSE All-World ETF. This continues my exposure to those US megacap stocks, but also other developed markets. With at present roughly 3,600 stocks in total, a reasonably low expense ratio of 0.19%. Yes, I know there are other all-world ETFs with lower TERs. It also boasts a distributing dividend and an average annual return of 27% since the fund's inception in May 2012. It's a solid pick for the cornerstone of not just this pie, but also my portfolio. Next, we have 15% of the pie allocated to WLDS, which is the iShares MSCI World Small Cap ETF. The purpose of replacing EQQQ with a World Small Cap ETF is to improve diversification by moving away from the large cap tech companies, by giving me exposure to, at times, undervalued or domestic focused companies. Small cap companies are often in earlier stages of expansion, allowing investors to capture significant capital appreciation if the company succeeds. That being said, although they can sometimes outperform large and mid-cap companies, sometimes in recovering economies, they do come with a higher volatility risk. So I think you have to be willing to accept years of underperformance for potential long-term gain. In regards to the ETF itself, it gives me exposure to another 3,500 companies from which to potentially benefit from, as well as an average annual return of 13% since the fund's inception in March 2018. And finally, 5% is allocated to the iShares Physical Gold ETF, SGLN. I've been looking to add a gold ETF to my portfolio for a while, and this ETF acts as a stabilizing agent within the pie, offering a hedge against inflation and market volatility, even despite its small allocation size. There are some that will say that gold is a pointless investment. Others may say that gold tends to hold its value over the long term, or when the economy finds itself in financial turmoil. I disagree with both those statements. Gold has, is, and likely will continue to increase in value. I don't think that's a strong opinion. I think that it's an easily verifiable fact. If we just look at this graph showing the spot price of gold in US dollars over a 5-year period, we can see it has a total growth of 212%. If we look further back and check the last 20 years, we can see a total return of 841%. I appreciate that past performance is not an indicator of future gains, but given that gold is still a much sought after resource, I feel it still has growth potential, whilst providing a counterweight to the equity-driven ETFs in this portfolio. Now, with all that being said, let's zoom back out. What have I actually built with this pie? I have global large and mid caps, global small caps, and a small gold stabilizer. This is what's known as a factor-tilted global portfolio. Instead of tilting towards a sector, like tech, as it was before, I'm tilting towards a factor. The factor in this instance is size, and that's a very different approach, and it's important to understand why. Sector tilts can be cyclical. Tech outperforms until it doesn't. Energy outperforms until it doesn't. AI infrastructure, which is now receiving a big push, outperforms until it doesn't. Sector leadership rotates over time, but size exposure is intended to be structural. Historically, across very long data sets I might add, smaller companies have delivered slightly higher returns than larger companies. Now that's not every year, it may not be every 5 years, but over very long periods that can be the case. This is often referred to as the small cap premium. Now, this part is very important. This theory is not guaranteed, but it is grounded in decades of financial research rather than recent performance trends. That's the key shift for me. I'm no longer asking what has done well. I'm asking what structure makes sense for me for the next 20 years. That's certainly a question I wasn't asking myself when I started investing. So in relation to the small caps, some of you may be asking, why 15%? Why not 5%? Why not 30%? The reason is that small caps are more volatile, more economically sensitive, and as stated earlier, they can be prone to long underperformance periods. Most well-constructed global portfolios that include small caps tend to allocate somewhere between 10% to 20%. Under 10%, the impact is likely minimal, although this may depend on the capital you have invested. Over 20%, and the risk of volatility jumps significantly. 15% sits right in the middle of that 10 to 20% range. It feels meaningful, but it won't dominate the portfolio. It increases diversification across company size without dramatically increasing behavioral risk. And behavioral risk is the real risk, because if you can't stick with it, it doesn't matter what expected return was. With that being said, I do want to talk about expectations. Not predictions. I think that's important to specify. We're talking about expectations. There is enough data available to suggest that over a 20-year time period, the global large and mid caps, global small caps, and also gold can all achieve an average annual return of 8 to 10%, which is exactly the range I was targeting when I started investing. So it's interesting to note that I haven't meaningfully increased expected returns. What I believe I've improved is the diversification quality. But I'm under no illusions, it won't be smooth. Investing seldom is. Small caps can underperform for 5 to 10 years. Gold can do nothing for years. But together they reduce reliance on one dominant driver. Now, if I'm being honest, the old 70-30 VWRL to EQQQ structure might outperform the new one. It absolutely could. The average annual return for the Nasdaq 100 over the last 20 years is just over 14%. But as stated earlier, a lot of the companies in the Nasdaq 100 are already covered within the VWRL ETF. So if US mega caps and tech stocks continue to dominate, the portfolio will still capitalize from that, just not to the same degree. But to keep the Nasdaq 100 ETF would be me betting on that. The new structure is not a bet. It feels more intentional, more like a design. Instead of increasing correlation between holdings, I've diversified return drivers. Instead of doubling down on the last decade, I've simply widened the exposure base. And over 20 years, and often with all manner of growth, widening usually beats narrowing. And that right there is my wax on, wax off moment for this video. Now, could this new structure be refined further? Possibly. A slight adjustment I could make would be to the allocation amount for each asset, perhaps changing to 82% larger mid-caps, 13% small caps, and 5% gold, with the view to slightly decrease the potential for volatility. It would keep the tilt meaningful and increase the core stabilizing exposure, but for now, an allocation of 80, 15, 5 feels balanced. This change will be happening at the beginning of March 2026, so if you're watching this, it's highly likely that the new growth pie structure is already in place. Not because I'm reacting to markets, but because I want this portfolio built properly before I scale it for 20 years. So the growth pie is evolving from tech concentration to structural diversification. As always, the community's comments are as important as anything on this channel. So let me know in the comments, would you have kept the 30% Nasdaq? Or would you tilt towards small caps? Or would you tilt to something else entirely? I've also recently rebuilt my income pie. If you'd like to know why I completely reshuffled the EI income pie and what the strategy is behind those new allocations, I've done a full dedicated breakdown that you can watch right here. If you're a beginner investor, if you're building with small amounts, or you just want realistic portfolio updates instead of fantasy projections, make sure you're subscribed to the channel. And as always, keep it simple, keep it realistic, and keep it effortless.